Natalie will share her insights on the ways a business can deduct taxes and how to claim them on a business tax return. Natalie Stiles is a chartered professional accountant with a passion for helping small business owners. With a focus on teaching, she offers practical guidance, advice, and service for starting and growing a business and understanding financial reports, along with preparation of bookkeeping and income tax returns. Natalie has the privilege to serve the entrepreneurs of Saskatoon and surrounding area through her accounting firm, Stiles Accounting and Tax Services. Thank you, Natalie, for joining us today, and Natalie will take over when she's ready.
Thank you, Deidre. Welcome, everyone, to Tax Deductible Business Expenses. Let's dive right in. We've got quite a bit of information to cover today. We're going to start off with talking about some of the basics, expenses for incorporated and for non-incorporated businesses. We'll dive into a few specific expenses: meals and entertainment, business use of home expenses, vehicle expenses, capital assets as opposed to expenses, and we're going to talk a little bit about personal portions of the. Everybody can still hear me okay? All right, let's get going with the basics. We'll talk about some basic questions here. First off, who can claim business expenses on their tax returns? Sole proprietors and partnerships and corporations who are carrying on a business for profit can claim these business expenses on their tax return. What can be claimed? Eligible expenses must be reasonable. They must be for the purpose of earning business income. There are some categories of expenses that CRA provides specific restrictions or qualifiers on, so you need to follow those, and it's important to keep itemized receipts. Those debit card and credit card slips are not going to be sufficient if you ever get stuck with a CRA audit. They expect to see itemized receipts showing what you purchased and the tax. Where do you report your business expenses? If you are unincorporated, a sole proprietor or partnership, you would report your business expenses on your personal tax return, Form T2125, Statement of Business Activities. If your business is incorporated, you would report this on your corporate tax return in a number of places, but primarily Schedule 125, Income Statement Information. The timing of when you report your expenses is based on something called the accrual basis. This means that when you incur the expense, that's when you report it. So if you have a supplier who bills you, but you don't pay them until later, you would record your expense at the time that the expense is payable, the date on that supplier bill. On the flip side of that, if you pay something in advance, for example, maybe your insurance you pay upfront for the year, you can only include the portion of that payment that relates to the current year in your current year taxes. You would record the rest of that in the following year. So I'm just going to bring up an example here that I have. Bear with me here. So for example, if your year-end date is December 31st, and you have an insurance policy that runs from June 1st of the current year to May 31st of the next year, you would take your total insurance cost that you paid this year and multiply it by 6 out of 12 months and report that portion on the current year's tax return. The remainder, like I said, would go on the next year's tax return. The timing of when you report your expenses also depends on what your year-end date is. For sole proprietors and partnerships, you must use the calendar year, December 31st. For corporations, you can choose a fiscal year for your corporation. This is done when you first incorporate, and the date that you choose must be within the first 53 weeks of your incorporation date. So you could have an October 31st or November 30th or any year-end date that you choose for your corporation, so long as it is within that 53 weeks. Why do we want to report expenses on our tax return? Because expenses reduce net income, which in turn reduces income taxes owing, which makes everyone happy. How do we do this? We keep our receipts, and we can either record them in a bookkeeping software or tally them up by category and report them on the tax return. So if your business is registered for GST, you would also make sure to deduct the GST on the receipt from the total expense amount and record it separately. Please note that PST is not separated from the expense amount because it is not a recoverable sales tax. I've got a quick little example here. You may need to make your screen a bit bigger to see. I've scanned in a copy of my purchase from Staples. I purchased some office supplies here, and just in that highlighted box there, you can see what numbers we're using to record and how those numbers are arrived at. So the total that I spent was $31.64, and I'm recording that as coming out of my bank account. I record the GST separately, that $1.43, and the remainder, the subtotal plus the PST, is included in the office supplies expense, and that expense will show on the tax return. Do we have any questions so far? Everybody following along fairly well? Not seeing any. Let's move forward. I've got an example here of what you can expect to see on the personal tax return for a non-incorporated business for the expenses. So these are excerpts from the personal tax return. We've got a listing here. You can see that we've got the cost of goods sold. So this is your direct costs for the business, starting with your opening inventory, your purchases, you've got your wages, subcontract, and then deduct the closing inventory. Okay, I've got a question here from Jocelyn. Thank you. Do you have to separate GST if you don't claim GST? No, you would record the entire amount as the expense if you're not registered for GST. Thanks for that question. Also on this tax return, we see the main list of expenses. We'll be going through a few of these in greater detail, but you can see that there's a fairly substantial list here, and they do give you a spot here at the bottom for other expenses that may apply to your particular business that they don't have listed here. On the corporate tax return, we've got the same cost of goods sold and the operating expenses categories. I'm just going to go to those links here. So for the cost of goods sold, there we are. Oh, I apologize. This doesn't seem to be working. Well, I know we've had some technical difficulties before. If I could get Deidre to help me, that would be great. But the essence of this is that there is the cost of goods sold, opening inventory, again the purchases, and your labor costs less your closing inventory. We've got a bit more detail on those pages, but unfortunately I don't think we're going to be able to see it right now. I'm not sure why it's not loading up. Oh, there we are. Okay. All right. So this is just a general, thank you, Deidre. This is a general look at what these expenses look like. We've got some very particular items in here relating to specific industries, but otherwise it's the general same look and feel as on the personal tax return. Let's see if the operating expenses are going to work for us. Maybe not. Maybe Deidre will have to help me again. Sorry, folks. There we are. Okay, And if this is coming up tiny on your screen, then I apologize, but maybe move to full screen so that you can see this. So we've got advertising expenses. There's quite a detailed listing here. I've got 4 pages worth. And I'll just flip through them quickly so that you can see. But there's a lot of information here. And it's not to say that you can't claim these on your personal tax return. It's just that CRA is laying these out a little bit more specifically on the corporate tax. All right, so that just gives you a quick look at where you're going to be reporting your expenses. Let's dive into some of these specific expenses because there's a fair amount to cover there. Oh, my apologies. I think I'm missing a slide. I did miss one. There we are. All right. We've got a few general expense restrictions that I wanted to go over before we get into those specifics. So for business taxes, fees, licenses, and dues that you saw listed there with the expenses, you are not allowed to include membership dues if the main purpose of the club is dining, recreation, or sporting activities. So that golf club membership, sorry, CRA says you can't claim that as a business expense. And you also should not record your income tax expense in this category. If you paid taxes in the year, then this is not the place to put them. We can discuss that portion later on, but this is specifically for things like your business license from, say, the city of Saskatoon, those types of things. Bad debt expense, if any of you have heard of this, this is any uncollectible amounts owing to you from your customers. So if you've tried your best to collect from your customer and it's just not going to happen, you can claim an expense for that amount that you're not able to collect. The only caveat there is that you do need to have that original customer invoice included in income, either in the current or in the previous year, whenever it was that you had originally billed them. If they do decide to come back and pay you later on, then you would just simply reverse this expense and include the amount. Repairs and maintenance, it's important to note here that you can't include the cost of your own labor for anything that you're fixing yourself. If you do take your equipment to a shop to have it fixed, then of course they are going to charge you labor. But the CRA views this as your labor cost is very is at your discretion, and so they want to remove that discretionary portion of the expense. Any penalties and interest that you get charged by CRA are not tax deductible. If you're late or haven't filed, for example, your payroll remittances or your GST return or your income tax return, and they charge you penalties and interest on late payments, then those expenses cannot be claimed on your tax return. Also, if you have been speeding off to meet with a client and you get a ticket, that is not tax deductible, even though you got that ticket while you're conducting business. Any fines for breaking the law are not deductible. Do we have any questions from any of the participants before we move on to those specific expenses? Okay, I'm not seeing any, but I'll keep watching if there are any. All right, let's move on. Let's talk about meals and entertainment first. So meals include food, beverages, taxes, and gratuities. Entertainment includes things like tickets for theater, a concert, athletic event, or any other performance, private box at sports facilities, room rentals to provide entertainment like a hospitality suite, and the cost of entertaining guests at a nightclub, athletic, social sporting clubs. It also includes any taxes, gratuities, or charges that you're paying. So Okay, I've got a great question here from Ashlyn, throwing me a curveball here. If I'm a food writer and I need to eat at a restaurant to write about the meal or experience paid for an article, can I claim the full amount of expense of the receipt versus just 50%? Ashlyn, that's a very specific one to your situation. So if you wouldn't mind emailing me, I'll have my information at the end of the session. Then I'd be able to get back to you on that one. Yeah, I know there are some gray areas here, and it's good to get clarification. So if you wouldn't mind, great. All right, I'll get back to you on that one. So generally, as you can see, that meals are limited to that 50% or a reasonable amount, whichever is less, according to CRA. So they're pretty stringent on that. So if you are registered for GST, then you get to claim 50% of the GST. So always your GST claim is going to be however much of the expense that you can claim, that's the same percentage of GST that you can claim. There are some exceptions to this. So we've got, if you're throwing a staff party, company barbecue in the summer, you can have up to 6 staff events per year where the expenses are 100% deductible. Any staff events that you have beyond 6 are going to be deductible at 50%. If you're buying restaurant gift cards for your staff or for your customers or clients, those are going to be subject to that 50% limitation because they are still considered meals expense, not a gift. Marilyn, I'm sorry we'll have to have you go there, but yes, this is being recorded and will be posted on the website, so please do tune in and catch up with the rest of the information. When you attend a conference, your meals must be recorded separately from the conference fees at the 50%. If the conference provider does not separate out the meals, and those are meals, not the break snacks, then CRA designates that it is $50 per day to be used as your meal cost. If you're a sole proprietor, can you have a staff party for one? You know, if that may not fall under what CRA considers to be reasonable. So, but thanks for the question, Jolene. All right. So, in this example here with the conferences, if you paid $200 to attend a conference, and that included meals for the day, you would be able to claim $150 as a conference expense and $25 as a meal expense because you can only claim 50%. So where does that other $25 go? If you are not incorporated in your business, you would record that other, the other $25 in owner draw, or if you're in a partnership, in your partner draw account. If your company is incorporated, you would record that against your shareholder loan account. If you are recovering your cost of meals and entertainment from your customer, you took them out to lunch and maybe your contract agreement with them said that all costs can be recovered, then you would bill back the meals and entertainment at 100% and in turn get to claim 100% of the expenses, so that it's essentially a wash on your books, and then the client or customer gets to claim 50% of the meal costs they pay. Can staff parties and deductions include families, significant others of employees, or can we only deduct costs for employees themselves? You would be able to deduct the full cost of the staff party, regardless of who's invited, as long as it is open to all the staff. It cannot be limited to a certain department or certain group of staff members. Maybe it's just management only. It can't be limited to that if you want to claim 100%. But if you're opening that up to families as well as all the staff, then the full cost is deductible from the business. So we've got a lot of people, it looks like, planning their staff parties. I know we're recording here in November, and I think Christmas parties are coming up. So great interest from you guys here on this. If you do have any more questions on staff parties, then feel free to contact me. I'll have my contact information at the end of the webinar. So one other exception to the 50% deduction is if your business provides food, beverages, and entertainment. So if you're in a restaurant business and you're purchasing food for use in your business, then of course those purchases are going to be 100% deductible, because you're buying inventory for your business. You're not buying food for your own consumption. And if you do buy tickets to entertain a client or customer at a fundraising event for a registered charity, the cost of those tickets are 100% deductible. So a nice little gift there from CRA. One thing to note, please make sure that you are writing on your receipts the client or customer name that you met with, if you come out to lunch, and the purpose of meeting. So, you know, I met with client A to discuss project X. Make sure that you're writing that on your receipt so that if CRA ever does audit you, you have proof that this meal that you paid for was actually relating to your business. Any other questions on meals before we move on? Okay, not seeing any. Let's talk next about business use of home expenses. The most misunderstood expense on a tax return. So particularly for non-incorporated businesses, you must meet one of CRA's conditions in order to deduct the business use of home expenses. You actually have to qualify to deduct them. So your home workspace must be your principal place of business, or you use this workspace exclusively to earn business income, and you use it on a regular and ongoing basis to meet your clients, customers, locations. So this is directly from CRA. This is not a desk in the corner of your house where you perform your admin tasks for 10 minutes a day. That does not entitle you to claim home expenses on your tax return, because you're using, when we say your principal place of business, generally that's considered to be 50% or more. So if you're spending more than half your time in your home doing your paperwork instead of running your business in your place of business, then absolutely you get to claim this, but I don't think that's a good business practice. So generally, if you just are performing basic admin tasks at home, you know, generally you're not going to be able to claim the business use of home expenses. Sorry to be the bearer of bad news on that one. But if you do use that space exclusively to earn business income, in my situation, my office is located in my home, and my office is a dedicated space. I don't use it for personal purposes whatsoever, and it's where I meet my clients on a regular basis. So on my tax return, then, I qualify under the second criteria there. So if you are meeting one of these criteria, you can claim the following expenses: heat, electricity, insurance, maintenance, mortgage interest, not the full mortgage payment, just the interest, and property taxes. And then they give a space there, of course, for other things like rent, security, and water. Those types of things can be included in other. The deductible portion of the expenses is generally based on square footage of your home. So you would take your square footage of your office over the total home square footage and calculate the percentage. That would be your business portion. Rent insurance. Thank you, Jolyn. Yes, rent insurance would be deductible as well. That's a good question. Thank you for asking that. provided that the insurance is on like how do I say, a tenant pack, I think is what you're getting at. Right? So there is a reduction in the deductible portion of the space if it's used partially for personal purposes rather than solely for business purposes. And it's based on the number of hours the space is used. So, for example, if you run a daycare at your home, and you run a daycare for 8 hours a day, 5 days a week, and you use your kitchen to cook meals for the children during that time, but you also use your kitchen to cook your own supper and maybe get a midnight snack. So you're not using this space, it's not dedicated to the business, it's mixed use for personal and business. So there is a calculation that CRA provides where you would reduce your business percentage in that previous calculation by the number of hours of the day that the space is used for your business. And we've got a question here from Margaret. What do you mean by maintenance? So maintenance is anything that you do to maintain your home, keep it in good repair, in good working order. You know, anything from furnace filters to light bulbs to paint touch-ups, you know, those types of things where it's just sort of keeping the home in good repair. This is not major renovations, or we'll talk about that in the next slide. I'm getting ahead of myself here, but it's not major renovations. It's just regular things to keep your home clean. It could include cleaning supplies as well, you know, to clean your home. So let's move on to the next one. Oh, we've got, this is what it looks like on the personal tax return. And this is where you would report at the top here. You have your square footage amounts, and you can see how it calculates the percentage that is allowable for business purposes. We've got all of those expenses that I had listed off. And we'll talk about this bottom portion here in the next few slides. So there's a catch to claiming these business expenses. It's not a terrible one. You can't create or increase a business loss with business use of home expenses, but you can carry forward any unused expenses to the next year's tax return. For example, if your net income from your business, your income less expenses, equals $100 your first year, and then you claim your business expenses, your business use of home expenses, let's say you have $150 worth of that. You can claim $100 to reduce your income to zero, but the remaining $50 will be carried forward to the next year. I will caution you here, there is a portion, I'm just going to go back to that previous slide here. Near the bottom here, we've got something called capital cost allowance. So I'll talk a little bit more in depth about this when we go to talk about the capital assets. But generally, I want to caution you here on when you're claiming business use of home expenses, it is not advisable to claim capital cost allowance expense. There's a reason for that. So your home is designated as your principal residence, and as such is not subject to capital gains tax when you sell it. And you want to preserve that designation. So when there's a change in use of your principal residence from personal to income producing, like you're running your business out of your home, you may be subject to capital gains tax on a portion of the sale of your home. So to protect yourself from that, you can still run your business out of your home, no worries there, but you want to make sure that you don't have a change in use according to CRA. So the way to do that is to use a small portion of your home for business. Again, CRA doesn't define this, but it's generally thought that less than 50% is considered a small portion. Do not claim that capital cost allowance, which is a depreciation cost on your home or home renovations as part of your business use of home expenses. Don't claim any structural renovation costs on your home because, again, that will be added into that capital cost calculation. So anything that's structural would be like plumbing, electrical, HVAC, putting up new walls, basically remodeling for the purpose of maybe creating a business space. Things like painting, putting in carpets, those are not considered structural, and those could still be claimed. But anything that is major and structural, you wouldn't want to be putting in here. So as long as you're keeping these things in mind, this is something that is drilled into the heads of accountants. Don't claim capital cost allowance on a principal residence because you will create headaches for yourself later. Didn't the law change this past year regarding capital gains on selling your principal residence? I'm positive. Marilyn, you've thrown me a curveball here. Why don't I get back to you on that one? I know that you now have to report any sale of your principal residence on your personal tax return, but that is outside the scope of what we're talking about today. So if you wouldn't mind emailing me at the end, I'd be happy to get back to you on that. Let's move along and talk about incorporated businesses. So when you're using a business for your home for your business, pardon me, and your business is incorporated, it's treated quite differently than when your business is not incorporated. So in this case, the corporation would pay rent to you, the owner, shareholder. Oh, I'm just going to pause here for a moment and answer a question. So when calculating utilities expenses for the month, I'm only claiming 10% of my residence. Should I just record the 10% of the bill as my monthly expense in my accounting software? There are two ways to record utilities expenses. If you're a GST registrant, I highly recommend claiming, as you've stated, the 10% as your monthly expense, because then you're claiming your 10% of your GST on that. If you're not a GST registrant, then wouldn't make a huge difference. If you're taking a close look at monthly reporting, then yes, you probably want to do it that way too. However, you can make one adjustment at the end of the year, tally up all of your home expenses, and then just record the allowable portion at the end of the year in one entry. So different ways to record that. It depends on what you're looking for in your reporting, and it depends on if you're a GST registrant. I find that if you're GST registrant and you just do this adjustment at the end of the year, then you have a big blip on your GST return because you're reporting sort of a lump sum amount, and that could raise a flag with GST. So not that it's wrong to do it that way, it's just that they may take a look at it and ask you why your GST is so much higher than all the past ones that you claimed. So, just a fair warning there. Any other questions, I guess, before I move on to the incorporated businesses, business use of home expenses? All right, I'm not seeing any, so feel free to keep typing if you did start, and I'll pause and answer your question. So, sorry about that. All right, so for incorporated businesses, the corporation pays rent to you, the owner. So if you are a one-person show, you're the sole shareholder of your corporation, then your best bet is that your corporation pays rent to you. The rental amount must be reasonable, and it's best to base it on the square footage, or I've seen where some people, maybe their corporation rents the garage or storage space on their personal property from them, maybe as a workshop for their business, or like I said, storage space for their inventory. So you may want to get quotes from outside suppliers if that square footage is not included in part of your home, just to have some reasonable basis that you can provide to CRA in the event if you have to audit it. So the catch to claiming business use of home expenses for a corporation is the corporation is paying the owner, so the owner's receiving income, and that rental income from the corporation has to be reported on the owner's personal tax return. A Form 776 statement of real estate rentals. You do get to claim the expenses based on the square footage of the space that you're renting out. But there is that extra step. So there's more calculation and work involved with doing it when you have an incorporated business. Tax tip here, it's good to make sure that the income that's being paid to the individual, or sorry, the rental expense amount that's the corporation is paying to the owner, that equals the allowable portion of the expenses, because otherwise you as an individual are going to be paying income tax on rental income that your corporation paid to you. So any excess over and above those expenses that you can claim, you get taxed on. So best to make sure that those amounts are lining up, and usually this is a year-end adjustment, because then you can take all of the expenses for the year, add them up, make sure you know what your allowable portion is, and then calculate from there what the rental amount should be in the corporation, match that up, and then you have a net zero amount on the personal tax return. And then the corporation gets to claim that rental expense on the corporate tax return. Any questions on that one? Okay, Jolene's got a question about GST. I'm sorry, Jolene, I'm not going into GST in detail today, but generally, you know, if you are registering for GST, you are considered an agent of CRA, and you're collecting from your customers and then remitting that amount to CRA. And they do give you a break by allowing you to claim the GST on your expenses. So really, when you're charging GST to your customers, you really do need to be setting that GST portion aside in maybe a separate savings account or something, because it's not really your money. You're just acting as an agent for CRA and collecting on their behalf. And then you just have to give them back their money. So, you know, it does create a little bit more paperwork for you. You know, it's not required that you register for GST. I can give you some more details on that if you'd like to email me. But I see that we're sort of running short on time here. We've got a bit more material to cover. So I welcome you to email me your question, and I'd be happy to get back to you on that with a little bit more detailed help. All right. Let's move along to vehicle expenses. So the CRA makes a distinction between motor vehicles and passenger vehicles. And this chart that I've got here is straight from the CRA website. They define the different types of vehicles, how much it's being used for business, and whether or not that qualifies the vehicle as being a passenger or motor vehicle. But why does it matter? Interest costs for passenger vehicles have a limitation dollar amount, and same with the lease costs, whereas motor vehicles are not subject to these restrictions. And the rates that I've listed here are for 2017. So if you're driving a car, you are stuck with a passenger vehicle. You know, if you're driving any other one of these vehicles, you may be considered having a motor vehicle. But we'll delve into this a little bit more as we go through the vehicle expenses. I'm going to talk separately again from a non-incorporated business perspective and from incorporated business perspective. Christine is asking, where is this chart from? So this is from CRA's website. I'll just go back to this. This will be archived on WESC's website, the recording of this webinar. So if you do need to refer back to it, you can certainly go there. Or if you're searching for it on CRA simply type in your search engine, a vehicle definition chart, CRA, it should come up. Right. So for non-incorporated businesses, again, your expenses must be reasonable and supported by receipts. And CRA requires, on top of that, that you need to maintain a logbook for your business kilometers driven in the year. This is very important. You don't have to submit your logbook or your receipts when you file your tax return, but in the event of a CRA audit, they will ask you to produce a logbook. If you cannot produce a logbook or receipts, they will disallow your vehicle expenses. And that will cause you some issues because the less expenses you have, the more income you have that's taxable. So best to make sure that you're keeping a logbook. CRA specifies that a logbook must include the date, the destination, the purpose of the trip, and the number of kilometers driven. Christine is asking, the logbook has to be separate from anything else. Yes, so there are multiple ways to keep a logbook, and typically your bookkeeping software, if you're using a software, will not track your kilometers. Or if there is a notation that you put in with your bookkeeping, it can be pretty hard to sort of summarize that because you need to have a total of kilometers driven in the year. So best to keep it separately. Sorry to see you go, Andrew, but please check back on the website and make sure that you catch up on the rest of this information later on. So multiple ways to record a logbook. There are several apps out there for your mobile device. A lot of them are free, and they will track your kilometers that you drive for your business purposes. If you're an Excel person like myself, then just simple chart in Excel tracking this information that they've got listed here. That works very well too. If you are old school and you love the paper and pen, certainly you can go to your local office supply store and pick up a logbook. They have a lot of those made up already with columns in there for the information that you need to provide. And you can just keep that in your vehicle and record those trips every time you start up the ignition there. The other thing that you need to track is the total kilometers driven in the year, which is the business and personal. So the best way to do that is to take an odometer read at the beginning of the end at the end of the year. And you'd take your December 31st or your year-end odometer read less the beginning of the year odometer read to arrive at your total kilometers driven in the year. So I always set a reminder in my smartphone and my calendar there on December 31st to remind me to take my odometer read. So what kind of expenses can you claim for motor vehicle? You can claim fuel, interest, insurance, license and registration fees. I just want to note that that does not include your driver's license. This is the cost of the vehicle. Maintenance and repairs, leasing costs, capital cost allowance. Again, we sort of touched on that, but we'll circle back around to that. And parking. So a few things to note here. Again, I talked about how there's limitations on the interest and leasing costs, depending on the type of vehicle that you have. For repairs, I found this interesting tidbit. If you are unfortunate enough to be in an accident while you're driving your vehicle for business purposes, your accident repair cost would be deductible as a business expense. But if you got in an accident when you were on a personal trip, those expenses cannot be claimed on your business. One thing to note with parking is that it is not limited to the number of business kilometers that you drove. The only stipulation is that the parking was a cost incurred for the purpose of earning business income. So you parked downtown because you were meeting with a client, that cost is 100% deductible, not limited to the number of kilometers that you drove. So this is what the form looks like on the personal tax return for those of you who are sole proprietors and partnerships. CRA asks for a little bit of information at the top there about the vehicle that you have. And then in that second section, you can see that they are requiring the total kilometers driven in the year and the business kilometers driven in the year, which then calculates the percentage of business use. So important to track both of those sets of kilometers. We also see that they have all of the expenses listed and that we had already talked about. Are there any questions on vehicle expenses for non-incorporated businesses before I move forward? All right, I'm going to tick along because we're getting short on time. The vehicle expenses for incorporated businesses are claimed differently depending on who owns the vehicle. If your business is incorporated, your corporation is a separate legal entity from yourself. So your vehicle can be owned by the corporation or it can be owned by you individually. If the vehicle is owned by the corporation or leased by the corporation, then the business can deduct those same expenses that we had seen listed on the previous page. And of course, those expenses must be supported by receipts. The catch there, though, is there may be a taxable benefit to the individual shareholder or employee when they are using the vehicle for personal use or if the vehicle is available for personal use. So there are two taxable benefits here. One is called a standby charge, and that's basically the vehicle is available for personal use. And the operating cost benefit is based on the personal kilometers driven. I'm not going to go into those calculations, but do be aware that those exist. When the business use is greater than 90% of the total kilometers driven, then these benefits really don't amount to a whole lot. So your best bet is to make sure that if your corporation is owning the vehicle, that it is designated fully for the purpose of business. You're not using it for personal at all, or you're using it very little for personal trips. If the vehicle is owned by you as an individual instead of by the corporation, then the corporation would pay the individual shareholder for the business kilometers driven. So as you can see here, you're going to need to keep a logbook if your business is incorporated too. CRA says that your corporation can pay your employee or your shareholder a reasonable allowance without it being a taxable benefit. So no additional income to report on the personal tax return in this case. So CRA says that a reasonable amount is equal to their prescribed rate, and that rate changes every year. For 2017, the rates were 54 cents for the first 5,000 kilometers and 48 cents for every kilometer thereafter. So as I'd said, it was not a taxable benefit, doesn't need to be reported on the personal tax return. It's basically a reimbursement. So the corporation then gets to claim vehicle expense for that allowance that was paid, and the individual does not need to report anything on their personal tax return. Or you could have the corporation reimburse the individual for particular vehicle expenses that relate to specific business trips. So, you stopped at the gas station for your trip to go to the conference. Then that particular fuel bill could be reimbursed by the corporation. In this case, where the vehicle is owned by the individual, then the corporation could claim parking expenses, but there wouldn't be any other expenses that they could claim. They can't use that same list that we saw in the individual tax return there of expenses, because they don't own the vehicle. It's not theirs, so they can't claim any of those other expenses. They're limited to the amount of the allowance that they're paying out. And just want to highlight again, make sure that a logbook is being maintained to track the business in the personal kilometers, because it does come into play with some of these calculations. Any questions on this before we move along? All right, we have capital assets, and then we're going to talk briefly about personal portions, and then we'll wrap up. So capital assets are considered to be long-term items, typically lasting more than a year, like your equipment, your building, and vehicle, and they're purchased for use in the business. Things that need to be included in the cost of your asset are shipping, installation, essentially any costs that get that asset ready for you to use. It does not include inventory items for resale. So if you run a car lot as your business, then you're not recording those cars as capital assets. They're recording those as inventory. But if you have existing assets and you're making improvements to them, here's a chart from CRA's website that helps you to determine the criteria for whether or not to record the item as a capital item or as a claimed expense. So, excuse me. So, you can just go through this chart again and refer back to it if you need to. So why does it matter? Non-capitalized purchases are expensed in the current year, but capitalized purchases are not. So if you want if you're looking for the full benefit of what you paid for in the year, you're wanting to make sure that things are expensed. But if it meets the criteria for a capital asset, it must be capitalized. But not all is lost. You do get to claim a portion of the asset as an expense each year. And CRA prescribes specific rates and classes of assets that you would use to record on your tax return. So this is capital cost allowance is the name of the expense, and it's essentially a recognition of the declining value of the asset as it's used in the business over time. So some of the classes I've got listed here, and this is not a full complete list. You can find that on CRA's website. There are significantly more classes, but I picked out some of the ones that you may come across a little bit more often than not. So, they give some of these rates here, and these are the amounts that you get to claim each year. But there's a catch to that. It's called the half-year rule. And generally speaking, anything that you're buying or adding to in your assets is going to be subject to this half-year rule. So only 50% of the capital cost allowance can be expensed in the year of purchase. It gets bumped up to the full rate in years following, but in that first year, you only get to claim half. And CRA does this because they recognize that not everybody is going out on January 1st or the beginning of their year and buying all of their assets for the year and then they're done. They recognize that you are buying assets throughout the year and may not be getting full benefit from the asset for a full year. So as an average, then they said, well, let's just let you claim half for that. When you dispose of an asset, you would record that as the amount equal to what you received on the sale of an asset. And we'll take a look at the tax return so you can see what that looks like. And generally speaking, assets are grouped into the classes. So there's some more accountant-y type things called recapture and terminal loss. I'm not going to go into in great detail, but recapture is considered taxable income. But again, there's a little bit more to that. just a little bit too detailed to get into today, but here's a quick look at what the capital cost allowance schedule looks like in a personal tax return, and this is where you would record your assets. So, excuse me. We've got a spot where you would enter the class number and a description, and it will automatically pop up with the corresponding rate. UCC opening, this is undepreciated capital cost allowance. So, sorry, undepreciated capital cost. And this will continue from year to year. It will carry the balance forward every year. So this is however much you had from the previous year. That's going to go in that first line there. And then I'm going to just skip down to that additions half year. So that's where you're going to put in how much you purchased in the year for that class of assets. There's the spot for disposals if you did have any assets that you disposed of. And then it will calculate out your capital cost allowance. And it will also give you the ending balance at the end of the year for what you can carry over to the next year and calculate an expense on. It looks relatively the same on the corporation for the incorporated business. So I'm not going to go into any further detail here. Any questions on capital assets, how to determine whether it's a capital asset or a current expense or anything about the tax return? All right, let's jump over to personal portions. This is just a quick little piece that I have about some of the remaining expenses that we haven't talked about yet. So there are some expenses that have a personal use component. Things like your cell phone that you use for business, you're checking your business emails, you're calling your customers on your cell phone, but you also text your mom on it. So, you've got some personal use component to it. Maybe your internet, maybe you're using that for, checking your friend's status on Facebook, and maybe you're using it for promoting your business on Facebook too. Travel. Perhaps you've traveled to a conference and you've extended your trip by a couple of days because you want to do some sightseeing. So these all have the potential for a personal use component. So why does this matter? Business expenses must be reasonable, and this means that only the business portion of these expenses can be claimed on your tax return. So you must document how you calculated the business portion. So if you use your hours use your internet for so many hours in the day, or you extended your 5-day business trip by 2 more days, then you would have 5 out of 7 days as your business portion of that trip. Excuse me. For GST registrants, again, only that business portion of the expense equals the business portion of the GST that you can claim. So if 70% of your trip was for business, then 70% is the GST amount you get to claim for your business. When you are recording this in your bookkeeping and then on your tax return, of course you record the, let's say, 70% as a business expense. The remaining 30% is recorded as a personal portion in your owner drawings or partner drawings if you're not incorporated, or in your shareholder loan account if your business is incorporated. So I've gone through a fair chunk of information at breakneck speed here, and I apologize for that. I know we had some technical difficulties at the beginning, but I just want to summarize here what we've talked about, just to give you a good overview again. And my apologies, I'm having a little bit of difficulty here. Just give me a moment. All right. So when you talk about the basics, what is a reasonable expense for the purpose of earning business income, and the importance of keeping those detailed receipts. We looked at some of the income tax forms and talked about the timing of reporting your expenses. We also talked about what was not deductible. Again, don't get speeding tickets on business trips because you certainly cannot deduct those. we went into some of the specifics with meals, business use of home expenses, and vehicle expenses. With meals, generally 50% is deductible, but there were some exceptions that we talked about where you could claim 100%, and there were some specific limitations that we went over. For home expenses, we talked about the difference between corporate and unincorporated businesses and the criteria you need to meet, and keeping track of things like your square footage and keeping all of the receipts for the list of expenses that we had there. And also drawing attention to that caution for the principal residence, making sure that you're not claiming capital cost allowance on your home. We'd also talked about the impact on the personal tax return when the corporation is paying rental income to the owner. We touched on vehicles, gone through a good list there of that CRA have provided to determine the type of vehicle that you have, whether it's a motor vehicle or passenger vehicle. Highlighted the importance of making sure that you're keeping that logbook, and also looked at some of those tax forms for the person, and talked about the different treatment for corporations based on who owns the vehicle, and the potential for some of those taxable benefits to you for any personal use. We briefly went over capital assets and talked about the capital cost allowance expense that's expensed each year, and briefly zipped through some personal portions and how to deal with those. So all in all, a very thorough presentation. I do have a couple of minutes for questions if you do have any more. If not, and you think of something later on, please do contact me. As promised, my contact information is here. You can reach me at natalie@stylesaccounting.com, or give me a call at 306-717-4172. I'd be more than happy to help you out. Thanks everyone for attending today. I think we've got Deidre here to close up for us.
I'd like to give a huge thank you to Natalie for taking time to share her insights. Your webinar was incredibly valuable to help understand regulations surrounding tax deductions. You clearly have a wealth of knowledge and a lot of great information that was very specific to Saskatchewan entrepreneurs, so we thank you very much. I would also like to thank everyone who joined us for this webinar. It is being recorded, so you will be able to go back and get some more information if there's anything that you missed. And don't forget, our next upcoming webinar is Reputation Management, and it's on December 13th. Barb McGrath from Above the Fold Canada will be presenting. So please check your West emails or visit our website to register. Bye everyone, and have a great afternoon.